As of 11:45 a.m. EST on Tuesday, January 6, 2026, Chevron, trading under the ticker CVX on the New York Stock Exchange, is priced at $163.05 per share, representing a significant intraday climb of 4.59%, or $7.15. This rally isn't just a minor bounce, it's a breakout that has pushed the stock toward its 52-week high of $171.79 as the broader energy sector experiences a massive surge following major geopolitical shifts in South America. While the headline figures look great, the real story today isn't just about a rising stock price, it's about the massive gap between what the average investor sees on the chart and what the institutional quants are actually pricing in behind the scenes regarding the future of global oil supply. Most people looking at this 5% move today assume it's simply a reaction to the Dow Jones hitting a record 49,000, but there is a much deeper curiosity loop here. Chevron is the only major American oil company that never fully left Venezuela, even during the most intense periods of political instability and sanctions. While competitors like Exxon and ConocoPhillips were walking away or fighting in international courts, Chevron maintained a presence, effectively keeping the pilot light on in a region that holds 20% of the world's proven oil reserves. Today, as reports circulate about a potential stabilization of Venezuelan oil exports under new administrative oversight, Chevron isn't just a participant in the rally, it is the primary gateway for Western capital to return to the world's largest oil patch. This positions the company in a way that almost no other global energy giant can match, creating a scenario where its logistical moat is suddenly worth billions more than it was just 48 hours ago. The common expectation among retail traders on platforms like Reddit and X is that this is the beginning of a massive supercycle for CVX, driven by the capture and extradition of Venezuelan leadership and the subsequent reopening of heavy crude pipelines. The narrative in these circles is one of unbridled optimism, with many believing that Chevron will soon be pumping millions of additional barrels with high margins. However, the reality on the ground is far more complex and involves a massive amount of infrastructure decay. While the geopolitical barriers are falling, the technical ones are just starting to emerge. The Venezuelan energy grid is essentially in shambles, and it will take years, not months, of capital expenditure for Chevron to actually see a meaningful return on these assets. The tension here is between the buy-the-rumor excitement of the retail crowd and the show-me-the-cash-flow skepticism of the major hedge funds, who are currently using this price spike to buy insurance through put options rather than chasing the stock blindly at these levels. If you look at the recent daily swings, CVX has been incredibly volatile, with volume today already exceeding 35 million shares, well above its 20-day average. This level of activity suggests that it's not just mom-and-pop investors buying in. We are seeing major institutional repositioning. In the last few sessions, we've seen a pattern where large blocks of shares are being traded at the open, followed by a steady grind higher. This usually indicates that big money is building or closing large positions through algorithmic execution. Meanwhile, short interest in the energy sector has been creeping up as some traders bet that the oil price spike will be short-lived. This creates a powder keg situation where any further positive news out of South America could trigger a short squeeze, forcing those bearish bets to cover and driving the price even higher toward that $170 resistance level. Comment below how many shares of Chevron you currently hold, and if you think the recent geopolitical moves are a permanent fix for the energy market or just another temporary spike. When we look at what Chevron actually does beyond the current headlines, it's a massive integrated energy machine. They aren't just drilling holes in the ground, they manage everything from exploration and production to refining and chemicals. Their business model is built on capital discipline, a phrase Mike Wirth uses constantly. This means they don't just chase every new project, they focus on high-return areas like the Permian Basin in West Texas and the offshore fields in Guyana. In their last quarterly report, they showed record upstream production of over 4 million barrels of oil equivalent per day. They've also been aggressive about returning value to shareholders, spending between $10 billion and $20 billion annually on share repurchases. While the company is pivoting towards lower carbon energy, investing in things like hydrogen and carbon capture, the core of the business remains firmly rooted in the fossil fuel economy, which still provides the vast majority of their $300 billion plus annual revenue. The sentiment in the online investing community is currently a mix of high-octane excitement and deep-seated frustration. On forums like r/value investing, there's a lot of talk about how Chevron's dividend, which yields over 4%, makes it a safe haven during periods of inflation. But on more aggressive trading desks, there's a growing frustration with what some call media manipulation. Many retail investors feel that the mainstream financial press downplays the significance of the Venezuelan assets to keep the price suppressed so that institutions can accumulate more shares at a discount. There is a palpable sense of us versus them, where retail traders are holding on for dear life, hoping for a breakout to $180 while watching high-frequency trading bots sell off every minor peak. This psychological tug-of-war is driving much of the intraday volatility we see, as every piece of news is dissected for hidden meanings about what the smart money is doing. Institutional activity lately has been tellingly cautious despite the price surge. While the stock is up, the options flow shows a significant amount of hedging. Large funds are buying calls to capture the upside, but they are simultaneously loading up on puts to protect against a sudden reversal if the geopolitical situation in Venezuela sours or if the Trump administration's plans hit a legislative wall. This barbell strategy shows that while they don't want to miss the rally, they aren't fully convinced that the reality has caught up to the expectation just yet. They're watching the upcoming Q4 2025 earnings report scheduled for January 30th, 2026 with eagle eyes. Analysts are expecting an adjusted EPS of about $1.54, which would be a dip from previous years, but the guidance for 2026 is what will really move the needle. If Chevron can show a clear path to integrating those Venezuelan barrels into their U.S. refineries, which are specifically optimized for that kind of heavy crude, the stock could decouple from the broader market and enter its own bull run. Looking ahead, there are several catalysts that could swing the pendulum in either direction. On the upside, any formal announcement of a new joint venture with PDVSA or a fast-track plan for infrastructure repair would be a massive tailwind. Additionally, if oil prices stay above $75 a barrel, Chevron's free cash flow will likely exceed projections, potentially leading to a surprise dividend hike. On the flip side, the risks are substantial. Geopolitical stability in a region that has seen decades of turmoil is never a guarantee. There is also the risk of oversupply. If too much Venezuelan oil hits the market too fast, it could depress global prices, hurting Chevron's margins in other regions like the Permian Basin. Traders are keeping a close watch on the S&P 500's energy index, as a sector-wide correction could drag CVX down regardless of its individual merits. The sentiment among long-term holders remains one of quiet confidence, but there is a distinct fear of missing the top among the more recent arrivals. Those who bought in during the 2024 lows are sitting on comfortable gains and are likely to hold for the dividends, but the newer momentum crowd is much more skittish. This creates a situation where any 2 or 3% dip could turn into a 6% slide as the momentum traders panic and hit the sell button, while the long-term value investors wait for even lower entries. This fragmented shareholder base is why the stock tends to have such sharp, jagged moves on the intraday charts. You have two different groups of people playing two completely different games with the same ticker. As we wrap up this analysis, the central insight is that Chevron is currently priced for a best-case scenario regarding its South American interests, yet it remains one of the most disciplined operators in the energy space. The expectation is that the geopolitical path is now clear, but the reality is that the physical and economic path to extracting value from those reserves is a long-term play that won't show up on a balance sheet for several quarters. Today's 4.5% jump is a testament to the market's hope, but the real test will be the company's ability to turn that hope into cold, hard cash flow in an environment where everyone is watching their every move. The contrast between the retail moon narrative and the institutional hedge narrative defines the current state of CVX. It's a stock that offers both the stability of a dividend-paying giant and the volatility of a geopolitical play, making it one of the most interesting and dangerous names on the board right now. To summarize, Chevron's current price of $163.05 reflects a market that is pricing in a massive geopolitical victory, but one that may be overlooking the significant operational hurdles that remain. We've seen heavy volume and institutional hedging that suggests that the smart money is preparing for a continued rally and a potential sharp reversal. The retail community is fueled by a narrative of historic recovery, but the reality suggests a more measured, multi-year process. Whether you are a long-term dividend seeker or short-term swing trader, the next few weeks leading up to the January 30th earnings report will be critical. The tension between the expectation of an immediate oil boom and the reality of a decayed infrastructure is where the true value of the stock will be decided. Keep a close eye on the volume and the options flow, as those are the footprints that will tell you where this machine is headed next. Would you like me to analyze another energy major like Exxon, or perhaps look into the specific oil field service companies like Halliburton that are also rallying on this Venezuela news?